This is your daily 10-minute business and finance news wrap for this Tuesday, the 9th of March 2021. I'm Ricardo Gonçalves. Later, business confidence hits a decade high, but first to the Australian share market, which finished this Tuesday up 0.5% on the 206,771. The banks doing well. Macquarie up 2.4%. Focus was a standout, up 8.6% on the takeover bid, but the technology sector was weaker. Afterpay down 3.4%. For more on the day's action, I spoke earlier with Chris Stott, the Chief Investment Officer at 1851 Capital. Chris, the market is up today. Why?
We really took our lead from Wall Street, where we saw the technology sector come under significant pressure. Our market finished higher for the day, but the technology sector was weaker on the back of the NASDAQ, which has officially entered correction territory with fears around interest rates going up sooner than people had anticipated.
Can we focus on those tech stocks because they were the ones that performed extremely well during 2020? Now that we're seeing this correction in the US and, the all technology index in Australia has also had a harder fall, is there time in the sun over, do you think?
We think so. We still think there's further downside pressure to come for the technology space. And that was the place to be invested, as you say, last 12 months, the stay-at-home trade when we're in lockdown, and things like Microsoft, Tesla, Apple were certainly the leaders of 2020. We don't think they'll be the leaders of 2021. So we still see further downside to the technology sector with interest rates climbing earlier than anticipated over the next few years and valuations coming under pressure in that regard.
So that move that we're seeing, I guess technology seen as growth, we're seeing a move to value. What does it mean for investment strategies and what are you telling your clients at the moment?
So value is certainly having its time in the sun. Over recent months, we've seen value outperform the growth part of the market for the first time in well over a decade. And we suspect that will continue going forward as people favour those value type names, in particular the names that have got high dividend yields with interest rates at zero and the prospects of rolling a term deposit at less than 0.5%, not particularly attractive. So we think that the chase for yield over the next 2 to 3 years will be very, very strong, perhaps stronger than what we saw coming out of the GFC, where companies like Telstra in particular were the beneficiary of that chase for yield.
So where do you see value at the moment?
We're seeing value particularly in the housing-related sector, with house prices experiencing a rapid recovery in parts of the country. Prices now are above where they were pre-COVID. In fact, the month of March looks like it could be the best monthly gain for prices in almost 40 years, with a few weeks to go. So we think the housing market or housing-related stocks like McGrath and Genworth look quite attractive to us on a 2 to 3 year view. We're also seeing good value in the telecommunications sector as well. So companies like Vocus today received a firm takeover offer from the Mirror Consortium at $5.50 per share. Another company that we like in that space is Unity Group, which is exposed to a similar thematic owner of fibre infrastructure and also a reseller.
And when we talk about rising interest rates, which is one of the reasons why we're seeing, or rising potential interest rates because of this switch, when we talk about that, how is that related to what the Reserve Bank might be doing though?
Yeah, it's a good point. And we've seen the long bond or the 10-year bond rally quite strongly in the last 3 months, almost double to be at around that 1.8% mark. So the expectation is from a lot of equity market participants right now is that interest rates will rise a lot earlier than the RBA have anticipated. And just to remind us, the RBA have said that interest rates will remain on hold until at least the year 2024, or where we have a sustained period of inflation between that 2 to 3% mark, which we think is a long way away. Really setting the scene, in our opinion, for a blow-off to the upside in economic growth over the next 2 to 3 years with very accommodative fiscal and monetary policy coming through. The prospect for rapid inflation in asset prices amongst a number of different sectors we think is quite high.
Chris Stott there from 1851 Capital. Now, NAB's business survey today showed that business confidence reached its highest level since early 2021, or 2010 rather. That's even as JobKeeper comes to an end in a few weeks. So for more on that, Anna Napoli spoke with NAB's chief economist, Alan Oster.
Alan, business confidence it's bound February. Why?
Basically, it's because you've got very strong increases in forward orders and activity levels. And people are basically, I think, saying, well, if we're going to get a vaccine soon, things are going to improve, and the economy itself is running very, very strongly.
So what does it mean for the economy in the short to medium term?
I think it means that in the March quarter, we'll probably have quite substantial growth again. Year average numbers, you're probably going to be like 4.5% or more. Previously, we've been around about 4%, but we'll have more details tomorrow in our forecast. But I think you would say that the economy is growing stronger than you previously thought, and that unemployment is going to be falling faster than you previously thought. And we'll just have to see how it goes. I mean, there will always be lumps and bumps, and I think getting rid of JobKeeper, it's not going to cause a macro effect, but it will cause problems in some tail parts of the economy, such as accommodation, food, if you like, travel agents, CBDs, education. And so the government has to be aware that whilst the economy generally is very good, there are still pockets of problems.
Alan Oster there, the Chief Economist of NAB. That is SBS On The Money for this Tuesday, the 9th of March. I'm Ricardo Gonçalves. You can find me on Twitter and Instagram at Business Ricardo.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.